Mike, it is everybody's favorite time of the year. Gather for the holidays with your friends and family and discuss the relative attractiveness of various investable asset classes. Hello and welcome to the Deep Dive by CAP STRAT.
Yep.
We figured for this deep dive we'd walk through our process for assessing that attractiveness and go through an example, the S&P. So let's start with the first sort of bucket we look at, the macro outlook. What does the macroeconomic situation look like? What's important there?
Our research suggests that liquidity, inflation, economic growth, and recession explain the overwhelming majority of variability in financial markets and economic outcomes. So these are the starting point for making asset class attractiveness forecast, return forecast within our investment framework. So specifically liquidity, growth rate of the money supply, is it higher, low, rising, or falling? Inflation, that's the price level, think core PCE or core CPI. Economic growth, real growth in the economy. And finally, recession, more of an off-on switch. Are we in a recession? Or rather, are we entering a recession?
Yep.
Or are we exiting a recession? Look, everything that happens in the world, we filter through this lens. And we think, let's just forecast these variables, take every event that happens, let's see it for what it is, forecast the data, filter out the noise, and create regimes. Is liquidity higher, low, rising, or falling? Inflation, higher, low, rising, or falling, etc.
Yep.
Those different regimes have different implications for the asset classes you want to own.
Yeah, exactly. It's not just what's happening with these factors, but it's historically when these factors have been similar, how does that impact the asset class in question, right? So looking specifically at large cap stocks here, right? Yep. So you referenced liquidity, inflation, economic growth, what's happening there, and how does that get us to this overall macro factor?
We have our 2025 forecast for liquidity, inflation, and economic growth. These fully take into account our expectations for Trump 2.0 policies and their impact on these elements of our framework, as well as our base case for Fed interest rate cuts in 2025, where we suggest 3 interest rate cuts from here in December, March, and then June.
Yep.
So speaking of the Fed, that immediately impacts liquidity. Liquidity low and rising, that's generally a positive environment for stocks, for US large cap stocks. The key there is the rising part. You want improving liquidity, the Fed cutting rates. That contributes 2.2%. Okay, all these numbers are going to come together at the end, so just bear with us. As we get into inflation, inflation recently has flipped. As we've started to price in Trump 2.0 policies and the potential impact of tariffs on the price level, inflation has gone from high and falling to high and rising.
Yep.
That's key. Rising inflation, stocks do not like rising inflation. They particularly don't like high and rising. The only thing that has going for it is that we're pretty much in line with the long-term trend. So we're not that high. We're certainly nowhere near where we were in 2022, 2021. So that's a negative, and that's partially being offset by economic growth, which is low and falling, but it's not that low and it's not falling that quickly. So we blend all these things together and we say the totality of this macro outlook, is this attractive or unattractive relative to history since 1960? And what you'll see is, based on this histogram, it's neither attractive nor unattractive. It's right around the 50th percentile, about the 46th percentile. So a very benign economic outlook in the terms of our investment framework. And this may be surprising because there are a lot of cross currents, but seeing all of them for what they mean for these variables, there are offsetting factors here that should basically wash out to neither a green or a red signal for large cap stocks in 2025.
Yeah, and inflation, of course, gets a lot of the news, or a lot of the noise, I should say. But these other factors are important as well. And viewers may notice that we haven't referenced anything about recession here, because as you noted, that is an on-off switch, and our recession signal remains inactive. Just giving our viewers a reminder of the recession entry signal requires 2 of these 4 underlying signals to trigger. Yield curve remains the only underlying signal that is active, and it continues to move towards deactivation. So we stay, no recession entry signal triggering now.
Yep. And if we get into a recession and we look forward to sounding the alarms on the recession exit signal, that is not our base case for 2025.
Yep. So that's the macro picture, and then diving into the asset class in more detail is the valuation side. Mm-hmm. What are markets already reflecting? How does this relate to long-term trend? How attractive is this?
Yes. said differently, if you knew the macro outlook with perfect foresight, what would you pay to own a basket of U.S. large cap stocks like the S&P 500, knowing what's coming down the pike? Are you paying too much? Are you paying too little? So what's already reflected in prices? We break that down into 4 factors. What's your long-term trend return? How far away are you from trend, high or low? What's your near-term momentum? Are you rising or falling? And then finally, that's all relative to the risk-free asset or the yield on cash. And that's how we can create valuation regimes.
Yeah. So if we dive in again for those large caps, you can see some of that displayed here. Long-term trend in the orange line, large cap price returns in the blue line. You can see, to your point, long-term trend 11.9. We are above that long-term trend.
Exactly.
Right?
You would look at this and say, long-term trend 11.9 plus my distance from trend, that's a negative. We're above trend. Markets have already priced in a lot of the good news that is factored into our macro outlook. The Fed being able to continue to cut rates, although slower than maybe the market would like, and the stimulative impact of potential tax cuts and what a Trump 2.0 policy mix means for the US economy. A lot of that's already factored in. What the market has going for it right now is it has some pretty positive near-term momentum. So that's offsetting part of this expensiveness that we get from the distance from trend. And then finally, we have to take all that relative to cash. Because if you're investing in a basket of large cap stocks, well, you're taking on risk. And how much risk or how much reward do you expect versus owning the risk-free asset? So we think this is the path of cash yields in 2025, down to something like 3.75%. If cash yields follow that path, and you owned a money market throughout the year, you would expect to earn something like 4% return. So you do that math, long-term trend plus distance, plus momentum, minus expected return on cash. Here's your valuation factor. Is that expensive, cheap, or in between? It's actually slightly on the expensive side. So the macro outlook, pretty benign, but the good news is more than priced in, you could argue, on the valuation side. Nothing extreme. We're not talking about tech bubble, but we're certainly not talking about market bottom during COVID or 2008 either. More so on the expensive side.
And paying off that tease from earlier in the video, doing a little bit more math for our viewers, adding the macro factor at 0.6%, the valuation factor at 6.1, gets us to an overall excess return over cash forecast of about 6.7%. How does that compare in terms of historical attractiveness?
It's in something like the 67th percentile. So it's a little worse than you would typically expect to be compensated if you're going to invest in a basket of large cap stocks. Now keep in mind, this is excess return, so it's over cash. So I know a lot of people are watching this video and think, just tell me your S&P 500 return forecast. If you put a gun to our heads, it would be something like 10.7%. All right. The key for us, we look at this within the context of a diversified portfolio. This number is not all that important. The absolute return forecast is far less valuable to us than saying how attractive are large cap stocks relative to all the other asset classes within our investment framework. And they're not that attractive relative to history. Part of that is because they're not that attractive relative to cash, and also not that attractive relative to other areas of the equity market. Things like small caps, value stocks. So plenty of opportunities outside of the S&P 500 as we move into 2025.
Absolutely. Well, that will do it for this edition of The Deep Dive. If you have any questions or comments, please feel free to reach out.